Welcome to Peerpoint Perspectives, the securities finance podcast delivering commentary from the best, brightest and most innovative people in the world of securities lending, repo, collateral management and related areas. Peerpoint Perspectives is brought to you by the consulting team at Peerpoint Financial. So now, over to your hosts.
Hello and welcome to Season 2, Episode 4 of Peerpoint Perspectives, the art of securities finance. I'm your host, Roy Zimmerhansl, and practice lead at Peerpoint. I met today's guest about 13 years ago, prior to the global financial crisis, when he was working at DWS. Manooj Mistry has extensive experience of developing and implementing investment products and solutions in the global asset management industry, and in particular, in index investing. He was formerly head of ETFs and Index Investing at DWS, which was the asset management division of Deutsche Bank. And he was part of the team that established the Xtrackers business in 2007, which is Europe's number 2 provider by assets under management. He also served as chief executive of DWS Investments UK Limited, with responsibility for traditional investments and UK distribution. But Manooj goes back right to the very beginning of ETFs in Europe. And prior to DWS, Manooj worked at Merrill Lynch International, where he was part of the team that launched the first ETFs. The product was called Leaders ETFs in Europe in April 2000. Now let me welcome today's guest, Manooj Mistry. So good afternoon, Manooj, and thanks for joining me today.
Good afternoon, Roy, and thank you for inviting me.
So, Manooj, you and I have known each other for quite some time, but you go right back to the beginning of ETFs in Europe, and I guess we've just hit a 20-year anniversary. So, why don't you tell us a little bit about, how did you get here? How did you get involved with the industry, and start at the beginning?
Sure. No, thank you. And my involvement or my sort of beginning in the ETF market came about by a combination, I guess, of luck, timing, and the fact that I was looking for a new job. So I started my career in 1994. I joined a boutique asset manager in the UK, which was subsequently acquired by Legg Mason. And there, in my 5-year career there, I did 2 roles. I was working in product development in the first part, and there I was developing fund products, but I was also developing index-linked structured products. And then after 3 years, I was given the opportunity for a change of role, and I actually tried my hand at active management for a couple of years. So I was an assistant analyst working on UK equity portfolios. But after a couple of years of doing the active portfolio management, my heart was in product development. And in the summer of 1999, I was approached by someone at Merrill Lynch who I'd worked with when I was working on structured products. And they mentioned to me that they were looking for someone to help them on the product development side, someone who could get things done. And this project was something called exchange-traded funds. So I had heard of exchange-traded funds, but I hadn't paid too much attention to them. In August 99, I joined Merrill Lynch, and I was joining on the sell side, on the investment bank, so within their equity-linked product business. And Merrill Lynch at the time wanted to replicate the success ETFs were having in the late 90s in the US, in Europe. And they had actually formed a consortium partnership with Dow Jones stocks, and also with 3 European stock exchanges. So it was the Deutsche Börse, the Frankfurt Stock Exchange, the Swiss Stock Exchange, and the Paris Stock Exchange, now known as Euronext Paris. So I joined in August 99, and then essentially the race was on, and it was a little bit like with the first moon landings. We were in competition with BGI iShares. So iShares are also looking to launch. So and they were looking to launch on the London Stock Exchange, and we set about trying to sort of beat them to the market. And I was proud to say that we beat iShares to launch the first ETFs, and these were ETFs were called leaders, LDRS, and we launched them on the 11th of April 2000, 2 weeks iShares launched their FTSE on London Stock Exchange, and that was the beginnings of the European ETF market.
Right. Well, look, I think that's really interesting. So obviously, I was aware of leaders in Merrill Lynch, but what I hadn't appreciated was the involvement of the exchanges as part of the partnership. So was that part of the original plan, or did it just sort of grow and develop, and it was decided that they would make great partners in it?
It was part of the original plan. So when I joined in August '99, the actual project had been running for almost a year before, and with anything, I guess, new and a little bit complicated, the project had kind of stalled. And one of the issues, or one of the ambitions we had, was to do a simultaneous launch on all three stock exchanges. But we soon realized that because of the nuances of local regulations, the UCITS regulations at the time, but also politics and also some of the plumbing issues which you have connecting between the exchanges, it was not going to be possible to launch on all three exchanges. So the original plan was to launch simultaneously on three exchanges with the same product. And the exchanges were very much involved. But then towards the end of the project, the Paris Stock Exchange was also, I think, had its own plans with the Euronext sort of mergers. So it was sort of stepping a little bit away. But we continued to work with the Deutsche Börse to launch on the Frankfurt Stock Exchange first of all, and then on the Swiss Stock Exchange 6 months later in September 2000.
And I guess, was that the multiple exchanges? Was the intention there to appeal to investors in each of those sort of major countries? Is that why you were planning on having multiple listings in multiple countries?
Exactly, yeah. So the idea was to access all the different markets and and I think, as I said, the exchanges were keen, and it is a little bit of, I guess, which exchange could also emerge as a dominant one in terms of trading. So they were all had a vested interest to make their exchange the most liquid and most tradable for the first products.
Cooperative, but yet competitive.
Exactly, yeah.
And I guess some of that legacy, though, is still with us today, where you'll have the same ETF listed on multiple exchanges, right?
Correct, yes. I think that's just the nature of the beast. Obviously, in the US, it's a very much a homogeneous market where you've probably got ETFs listed on maybe one, maybe two, three exchanges. Europe is much more heterogeneous in the sense that there's different tax laws, different regulations, different language currencies across the Europe. So that basically meant was that we had to go for the local listings in order to be able to access markets locally and make it efficient for, especially, I guess, retail investors to be able to buy. So it's much more cheaper for a UK investor to buy something on the London Stock Exchange as it is for them to buy via the Frankfurt or Milan stock exchanges.
Right. So I think we may come back to that point, because, of course, that also throws up various challenges as a consequence of taking that approach. But so you started with leaders. Where did you at Merrill Lynch, and where did you go from there?
Yeah. So we launched just at the end, or sort of the beginning. At the end of the dot-com boom, but at the beginning of the dot-com crash, and there were high hopes that ETFs would take off in Europe immediately, but we found that it was a challenge, and despite sort of I guess the products being launched, it was probably too early in the stage or the development to expect the products to be a sort of immediate success. And there were a number of factors contributing to this, namely from the regulatory side. We saw that it wasn't straightforward to passport the ETFs into different jurisdictions. So we spent a lot of time educating regulators in terms of how the products worked, what the features were, what the benefits of investors. I think one thing they struggled with was why would investors want to buy them off the exchange? So we had to explain the benefits of secondary market liquidity, improved access to the products. Also, I think in terms of the end client market, it wasn't ready at the time. So one of the things we found was that when we launched the ETFs, in the institutional community, they were seen as too expensive. So the first ETFs were launched on the Eurostoxx 50, were with a very healthy total expense ratio of 50 basis points. These products are now sub 9 basis points. But at the time, we had a product at 50 basis points tracking the Eurostoxx 50. And what many investors who were, say, for example, using futures or other derivatives for their index exposure, 50 basis points was way too expensive. So we weren't going to break into the sort of the traditional index institutional clients. Also, in the kind of what I call the retail institutional market. So this is the private banks, wealth managers who are managing money on behalf of retail investors or private investors. These guys were very much still following the model where that they did their own stock picking or bond picking in the client portfolios. Also, in terms of selecting actively managed funds, it was their raison d'etre to provide that service for their clients, and for which they charge a fee. And a product such as an index fund ETF was completely opposite to what they were looking for. So it was very difficult to get traction in these markets. And also at the time, with the dot-com crash and everything, I think there was a lot of obviously aversion to buying equity products in the markets. So with all that uncertainty, the start of the European ETF market was very slow. And at the time in 2003, Merrill Lynch, because I was based within the investment bank, also was going through, restructuring and looking at which businesses it wanted to focus in. And at the time in 2003, it was decided that they wanted to pull out of the market to provide ETFs. And they sold the business to BGI iShares in September 2003.
Can I just stop you there? So
Sure.
if we do kind of the snapshot there, it's the introduction of ETFs like it was in the US, but very much focused on retail investors, where that was the only community where it appealed to from, I guess, both a pricing and a preference point of view, because as you were saying, all of these other professional managers thought that they could do a better job themselves managing portfolios, not necessarily index portfolios, but just managing portfolios, right?
Yes, that's right.
And with a heavy sort of regulatory overlay in terms of cost of listing in multiple jurisdictions in the absence of passporting, right?
Yeah.
And then also, I guess, Merrill Lynch probably not seeing itself as really as much of a retail firm in Europe as maybe their own history in the US would be, where there's always been a big presence in sort of the high net worth retail investor in the US. So a different kind of corporate profile.
Exactly. Yeah. So no, there's a strategic decision at the time, which they made, and I guess at the time Merrill Lynch got a good deal for the business. So I guess there wasn't any sort of regrets on their side at the time, I guess. But it did allow the first sort of consolidation or first sort of M&A activity in the European ETF market. So.
Yeah, the first, but not the last. And I guess BGI had sort of a long history in its predecessors with Wells Fargo Nikko in terms of index management. And so I suppose it kind of fit quite well with that and looking for them to expand and accumulate capability.
Exactly, yeah.
So you were then moving into more of the institutional side on the structured products in Merrill, and where did you go from there?
Yep. So as I was saying, I think although I'd stopped working on ETFs, I thought they were very good products. So in 2006, Deutsche Bank approached me and they wanted to enter the European ETF market. And there was an opportunity to come back to ETFs, and I sort of snapped up the opportunity and to join Deutsche Bank because I was excited that to get back into the ETF market. And also in that time, the market had evolved and moved on, and we were now seeing the first kind of steps towards institutional professional investors uh, using asset allocation to drive their returns. And within that sort of framework, ETFs were proving to be a very attractive and useful building block for many professional investors. And we were now seeing that the market was starting to take off in terms of number of products, different market access, but also just generally in terms of assets and volumes as well on the different stock exchanges. And it was, but in 2006, it was a perfect time to come back in and enter the market, or re-enter the market in my case.
So a major European entity with very much a European, huge European presence and focus, looking to make a commitment into that. The early days of that, we didn't overlap at Deutsche Bank. I left a little bit before that in 2005, but discussions were already underway, and some involvement between the investment bank and the asset management side of the business. So they're definitely formulating the thinking then. But they kind of took a different approach. We can talk a little bit about you joined Deutsche, and what was the focus and objective there?
Yeah, sure. So when you were there, you probably were involved with the two products that were launched, I think, in 2004, and they were a partnership between the investment bank of Deutsche and the asset management arm DWS. And they launched two physical replication products, one tracking the DAX index and another tracking the Eurostoxx 50. And when I joined in 2006, these two products were still there. And the plan was, first started talking to them, was that we would build on these two products and extend the breadth of products, and also distribution of the products across different exchanges in Europe. But also, sort of during that time, there was also a kind of observation that within the European ETF market, there were two different business models evolving. So the first, which was the path followed when I was at Merrill Lynch working on the leaders products, but also followed by iShares, and was using physical replication. But the second approach we saw was the emergence of swap-based or synthetic replication, and this approach was being taken by some of the European providers, namely Lixor Asset Management, so part of SocGen. Their first ETFs, which they launched in 2001, were using swap-based replication. Then in 2005, Hypervereinsbank, who was subsequently ETF business was subsequently acquired by BGI iShares. They also launched some swap-based products, and basically the reason banks were launching the swap-based ETFs was that they thought that it was a much more efficient way to provide index exposure. And at the time in 2006 at Deutsche Bank, there was a debate about, okay, which is the most sort of more efficient way and which is the more scalable way to build an ETF platform. And at the time, the colleagues at DWS were very much focused on active management. And for them, they did not see too much value in low margin indexing products. So they kind of opened the way for the investment bank to launch the ETF platform. So when we launched the Xtrackers platform in January 2007, it was basically using the investment bank's trading and distribution capabilities.
Maybe I can stop you there,
Yeah.
and maybe we just take a step back. And can you do sort of a high level overview comparison between physically backed ETFs and swaps, and kind of pros and cons for listeners?
Sure. Yeah. So with the physically backed products, you're essentially buying the underlying constituents of the index to track the index, and you buy this in the same proportion as the weighting in the underlying index. And for, say, a FTSE 100 index, you obviously buy 100 and then you rebalance as required, or adjust the portfolio whenever there's a corporate action. If you're buying a broad index, say something like MSCI World, then it's probably not feasible to buy all of the 1,600 or 1,700 constituents in the index. So you'll probably do then some sort of optimization to get the index performance. And obviously, by doing that, you introduce some tracking error. You introduce the possibility that you can't match the exact index returns. So this was something which opened the way for swap-based replication, whereby essentially the tracking risk was being transferred away from the investment manager to the trading desk of a bank. So under a swap-based ETF, as I said, you were using the framework of the UCITS regulations, which provided sort of limits on counterparty exposure, and also in terms of the diversification. But it also allowed the fund to enter into a swap agreement or swap transaction where you could get the perfect index performance. And from an investor's perspective, if you bought a swap-based ETF, you knew that you were going to get the exact performance with minimal tracking error. The actual risk of tracking the index was then the responsibility of the swap counterpart and the trading desk at that swap counterparty, and they would essentially hedge the index in the way they thought the best.
Right. And interestingly, and perhaps unsurprisingly, the banks that were the leaders in the swap-based products were also the banks that were the leaders in just equity derivatives or derivatives generally anyway. So it seemed to make sense from that perspective.
Yeah.
But presumably that's harder for retail investors to understand. Like what is the swap? If you ask the average person, they probably don't know what that is. So did that present challenges in trying to sell to investors?
So initially, this is going back in 2006, 2007, there weren't too many challenges, to be honest, because we were still focusing on the professional market, and the retail portion in terms of direct retail investors was still a very small percentage of the overall kind of client users of ETFs. And in markets like Germany, there was also a very well-established certificates and warrants market. So in markets like Germany and also France, for example, in Italy, people were used to buying investment products like certificates and warrants, where they took on counterparty exposure. So it wasn't something that an alien concept to retail investors in those markets. And what we saw was that until the financial crisis, there was very little focus on the fact that it was an investment banking product with a swap providing the exposure. It was only after the financial crisis of 2008, 2009 that there came about a focus on, okay, this product is using a swap. What's a swap? Am I buying a product that's a black box? What does it do, etc.? So that sort of scrutiny only stepped up after the financial crisis. Pre-financial crisis, it didn't come up too much in conversations, and the focus was actually on the benefits of the methodology. And as I said earlier, people were focusing on the better tracking performance, both in terms of tracking error and tracking difference, and also in some cases, like for example, on a FTSE 100 or products where you have stamp duty, this because the banks hedging the swap were exempt from paying stamp duty. You could also get much more efficient access to some markets. So those were the benefits that were being.
Right. So before the GFC,
Exactly.
it had kind of grown into a more frequent use by professional investors who would have been familiar with sort of derivatives and that type of product, who were really only looking to try and get exposure to those indices. These provided a better or lesser tracking error, and so it achieved what they needed to do. And then you get the GFC, and
Exactly.
Lehman appears, and chaos reigns for a little while. What was the impact on the market then?
This was, and one of the things which always I like to mention is that throughout the 20-year existence of ETFs in almost 30 years existence of ETFs in North America, is that they've passed every kind of test of character and test of resilience that's been thrown at them. And after the Great Financial Crisis, or during the Great Financial Crisis, ETFs came out of it with a very strong reputation, in fact, and there weren't any kind of material failures of ETFs. There weren't any sort of instances where ETFs had to stop trading. They continued to function. There were other products which weren't regulated ETFs, so they were sort of exchange traded notes, which may have had issues. But the UCITS ETFs continued to function and do what they say on the tin. And in fact, at Xtrackers at Deutsche Bank, we actually saw an increase in volume in assets, but also trading activity in the ETFs we were offering, because we saw a switch away from mutual funds, actively managed mutual funds. We also saw that a lot of clients who maybe were until then buying stocks and bonds directly, but they were then happy to trade or get that exposure via an index, and the ETFs were providing a good kind of access tool for them to do that. It was only, I guess, 1 or 2 years afterwards, in 2010, 2011, that the debate regarding sort of physical versus synthetic replication started. And at the time, I guess, at the time we sort of called it, there were a lot of misconceptions or misinformation about synthetic ETFs. I don't think the term fake news existed then, but I guess you would call it fake news now. But there were a lot of, I guess, campaigning from various sources questioning the validity of synthetic ETFs. They questioned why banks were involved, what their motives were, but also in terms of saying to investors that there were a lot of risks involved with buying these products, because you were basically entering into a fund which was buying a contract with an investment bank, which are all risky and caused the great financial crisis. And also at the time, regulators who I guess were caught sleeping during the great financial crisis also started to take a bit more interest in what market innovations and seeing what was happening. So I always use this term.
Can I just pause there?
Sure.
Because I think that's a really great point. So we come through the GFC. ETFs have done well, as you said. They perform better than many other products there. A few different things. One is, as you said, there was the trend where more people were all of a sudden allocating to ETFs, so the interest and the assets under management were growing. Regulators, I think, if I'm not mistaken, during that time, in the U.S., the SEC had a moratorium on synthetic ETFs being launched, so it was kind of on hold pending some determination. And so the real battleground was in Europe, and all of a sudden, as more assets come in, there's more ground to battle over. So it became quite a heated debate, as you're saying, and regulators who kind of, in many cases, particularly in the U.S. and less so in Europe, had really missed all of the issues related to derivatives in the U.S., so things like the CLOs and CDOs and CDSs that were really that are part of all the films about the GFC. They were concerned, I think, to say, geez, these ETFs now are gathering so many assets. Are we sure they're okay, right? Is that kind of growing assets, more utilization, but uncertainty from regulators and asset managers trying to fight over, who is going to win this game? Is that a fair kind of summation of the situation around, say, 2010, 11, 12?
Yeah, no, definitely. And I think we definitely saw that pre-2008, 2000, there was very little attention paid by regulators. But then after that, after the financial crisis, there was a lot more scrutiny to try and understand how the products worked, and which was good because we were all very much in terms of open and very, very happy to cooperate and extend the education on the products. And I think one of the things here in Europe, as you say, was that the battle was quite intense. And at one stage, if you looked at the market share of swap-based synthetic replication ETFs in the European ETF market, it was at 45% in 2011. So, and this obviously 45% was mostly dominated by sort of investment bank backed ETF providers, so sell side ETF providers, and they were sort of stealing market share from traditional asset manager based sort of ETF providers who were focusing mostly on physical replication. I guess two things which I guess drove the sort of the market away from synthetics was that because of some of the misunderstanding out there, the professional investors who were in the pre-financial crisis, who were happy to buy the swap-based ETFs, they then took the view was that this is not a conversation worth having with our clients to explain to them why we are buying a swap-based ETF. I think what also was unfair at the time was that there was a very undue focus on the ETFs, of synthetic ETFs, because within the wider framework of investment products available, there were also at that time products like absolute return funds, which were also using derivatives to provide exposure. And in those products, they were going long and short and with leverage. But there was very little focus on derivatives usage in traditional mutual funds. And it was all very much focused on the ETF market, which was unfair. But as a result of that, we did see a slowdown in the demand. And between sort of April 2011, when there were three big papers from sort of international bodies which basically slammed synthetic ETFs, and the following summer of 2012, when ESMA produced its guidance on UCITS ETFs, I spent probably 50 to 60% of my time talking to regulators, central banks, and other supervisory bodies defending the synthetic swap-based ETF model and explaining that everything was done within the framework of UCITS. As I said earlier, there was a very clear rules in terms of counterparty exposure, diversification, etc. And also voluntarily after the financial crisis, we had Deutsche Bank at the time also were disclosing who the swap counterparty was or the exposure to the swap counterpart. We were also disclosing the collateral or the basket of securities which the funds were holding. These were all available on the website. So we were going the extra mile in terms of transparency. But what we couldn't change was investor perception. And I always say is that we won the battle in that when the ESMA paper came out in the summer of 2012, they actually didn't change anything for swap-based ETFs. They actually sort of basically confirmed that the setup was robust and there weren't any undue risks to investors. We won the battle but lost the overall war in that investor perception had changed and that they wanted to go for more physical replication products.
So I was going to say that I just wanted to make that point that the synthetic ETFs led by Deutsche were actually, they became the most transparent of the ETF issuers, as you say, available on the system, really set the standards for, for all ETFs to follow. So, oddly, the thing that people were most concerned about were the ones that actually they had the greatest insights available to them.
Exactly, yeah.
So that eventually synthetics kind of became small proportion. Did they ever disappear completely, or was there kind of a core that continued on?
Yeah, so for some markets, we continued to offer synthetic, but what we did do at the time was switch some products from the swap base to physical replication, but also the bias in terms of new product launches was towards physical replication. So as a result of that, and then also just clients generally buying more physical replication at Deutsche Bank Xtrackers, we saw that the percentage of swap based went from 100% in 2012 to less, around 25% in 2020. So the swap based ETF portion decreased, although the absolute number in terms of assets was still higher than in 2012. But the actual percentage of total assets, it was decreased. Saw that across other providers as well as they changed their business model. And what we now have in Europe is that my personal view is that the model will be that providers that can offer both will continue to offer both, but the weighting of assets will probably be skewed, say 80% in physical replication, 20% in synthetic.
Right. So it is that combination of the transaction structure and the markets. In some cases, that means that synthetics will always be part of community. But look, DWS, I guess must have been successful even with the transition. Everything. I think it was or still is the second largest ETF issuer in Europe. Right.
That's correct. Yes.
So look, that's an interesting sort of history of sort of the 20 plus years of ETFs in Europe. Just a quick thing, where do you think it goes from here? What do you think the challenges are? The growth, it's been exponential growth. That's why your figure that you gave is DWSN from 100% synthetic to 25% synthetic over that 8-year period. But in fact, in absolute terms, you still had more synthetics than you did in 2012. So talk to us about where you think the market goes from here.
My view is that the market will continue to grow. And we see that obviously investors or the market still needs to save, both personally, investors personally, but also from an institutional perspective, pension funds. So within a growing market, there is plenty of sort of opportunity. Also, I guess a lot of focus on value for money. This is being driven sort of from multiple angles. Firstly, from a regulatory perspective, but also just general competition, but also in terms of people are sort of saying, okay, what do I actually get in my investment? And that increased level of transparency is also favoring products like ETFs tracking benchmarks. And within that framework, ETFs stand to benefit. I think the factors continue the success are there. I think one of the things which we see in Europe is obviously the market is still very fragmented in terms of products listed on a number of exchanges. And what we are seeing is that there's an emergence where assets are concentrated in the biggest products. And then there's a tail of smaller products. One thing which I guess will be interesting to see is how that tail evolves over the coming years, whether products will drop out, whether products will merge, to make the overall industry more efficient. I think asset management, as other areas of financial services, are facing increasing competition from disruptors, but also just generally focus on efficiency, focus on sort of making things better in the system. But it'll be interesting to see how some of these smaller tail of products, whether they survive or whether they will basically disappear as asset managers go towards a more sort of scalable and more efficient platforms.
Yeah, and that's a good point. Banks have this history of never once they've created a current account or a banking account structure, never letting it die. So even if they end up with a small number of clients, they just carry them on in perpetuity, which has obviously cost implications. And the same thing, I guess, applies to long-standing funds that have never really captured enough money. And in today's market, this isn't the 50 basis points you were talking about earlier. Fees are under challenge. Right? One of the things I wanted to explore was securities lending. So a lot of the people listening to this will be in the securities lending market or be dependent on it. You've been a lender for many years. I'm wondering if you can share your experiences on securities lending.
So when we had the leaders ETFs at Merrill Lynch, that's where I got my first experience of securities lending. So, and the view at the time was that obviously, if there was a way to extract any benefits for the performance of the fund, which can be passed on to the end investor, it was always a good thing. So I started experiencing or had my first encounters with securities lending back in 2000, and there it was relatively straightforward to set up, and it was something that delivered returns, especially on something like the Eurostoxx 50, where it was possible to extract positive returns to which could be passed on to the investor. So my initial experience of securities lending was very positive. And then when I joined Deutsche Bank to work on the swap-based ETFs, securities lending was something which was obviously not a feature of the swap-based ETFs, but within the context of the investment bank and the trading platform, the securities lending desk would play a role in terms of supporting the business, in terms of supplying collateral to offset counterparty exposure, but also where, for example, the bank was hedging the indexing exposure, those securities could also be used by the securities lending department or team to generate revenues for the bank. And some of those revenues would also be passed on in terms of the performance of the swap. So in the same way with a physical replication product, if you were generating securities lending revenues, you would pass those in the return to investors. With a swap-based ETFs, you could also do that, albeit this time the lending activity is done via the bank's trading platform to the securities lending desk. So this was also a way in which investors benefited, so both directly and indirectly, depending on the model we followed. And when we set about looking at physical ETFs, and when we were transitioning from the swap-based, securities lending was obviously top of the mind there as well. And we wanted to make sure that we could do this in the most efficient way for the funds. And I guess in terms of looking at the lending market, it's very well established. It's worked very smoothly. And in terms of, I guess, investor appetite for risk, I guess there was the right kind of balance between, okay, if you take more risk, the rewards are higher in terms of the type of collateral, the level of over collateralization used. So these are all well-established principles, which I guess the securities lending market understood. I guess in terms of where I see challenges on securities lending, they mostly, I guess, and maybe this is something where you could also comment, Roy, is that what we typically found was that for small size funds, it wasn't always easy to lend out the securities because the counterparts had minimum size requirements or minimum lot sizes that they could lend out. So obviously the onus was on us to get the funds up to a decent size to then be able to lend out the securities to generate returns. But in the beginning stages, the fund would obviously suffer because they weren't able to partake in securities lending activities.
Yeah, and I think that's probably reflective of the overall securities lending market, where the requirement on the borrowers to have to have done full due diligence and have credit lines in place for all of the underlying beneficial owners, the need for that and the focus by regulators on that has only increased over the that you've been involved. 20 years has seen a dramatic change in that. And there's no question that there's a huge number of beneficial owners there and a limited amount of credit analyst time at investment banks. So they prioritize the big funds. And that is absolutely an ongoing challenge. Look, I don't want to go off topic, but I think you're right to identify that. How do small investors participate once they're in the pool, once they're approved and they're part of the fair distribution algorithms? They can participate, but it's getting over that hurdle of approval. We have ideas on that, but the discussion about ETFs. So other than the smaller funds and their ability or inability to participate, any other sort of suggestions, proposals, things that you would like to see improved or make it better for ETFs?
No, I think generally, I guess the only other aspect, and which is in Europe, the market for lending out ETFs is probably not as developed as in the US, where a lot of long-term holders of ETFs actually lend them out to market, which also generates a positive return, which can then be passed on to investors. So this market, I guess, is still in its infancy in Europe. So I see that as a potential opportunity also for investors to be incentivized to hold ETFs, is that they can then know that they can lend it out to generate some additional revenues for them as well. I think this is another segment which has an opportunity to develop and grow. But overall, my experience of securities lending, both within the investment bank, but also working at an asset manager and using the services of lending agents, was positive. And this is, as I was saying, it's something where it is possible to extract extra performance which can be passed on to the end investors. So it's I see it as a very essential activity, especially in indexing, where you want to make every basis point of performance count.
Great. And I have a little button on my controller here that would do sound effects, which I could put some clapping in to reinforce your idea about lending out the ETF themselves. Clearly, we've been talking about that for a decade or longer. And again, there is an interest in that. And as you say, it's a much more developed market. And that's available to people. People want to borrow these. We've been talking for a little while here. I'm wondering if you have any thoughts on ESG and ETFs.
It's obviously very much a focus of attention. And if you look at what's been happening in the European ETF market over the last 12 to 18 months, the majority of launches seem to either have some sort of ESG screening and or around thematics as well. So which also lend themselves to sort of ethically screening products. I guess with ETFs, they track an index, and with the emergence of ESG as a critical aspect of investing now, and it's one of those things where it's not. My personal view is that it's not going to disappear. It's here to stay for the longer term. I think people's perceptions towards it have changed, or towards application of ESG in portfolios is changing. ESG has been around for many years, but in the early days, I think there was very much a wait and see attitude in terms of, I don't need to do this until I'm forced to, or I don't need to. Why should I sacrifice performance in return for sort of screening out certain stocks? What I saw when I was at DWS, I was also responsible for the institutional mandate business. And over the last 4 or 5 years, we saw that for pension funds, corporate, and especially sort of government-sponsored pension funds, ESG was becoming a very important criteria. And we were seeing more and more RFPs where there was some sort of screening coming in. And so that was the emergence of a trend which was started 4 or 5 years ago, and it was basically built into every requirement, or every RFP had some sort of question on what are your ESG credentials. And this has obviously made its way into what I call the fund universe. Obviously, when you're launching a fund, it's difficult to create a product that may meet everyone's expectations of ESG. With an institutional mandate, you can create a very bespoke portfolio based on the institution's requirements. With a product like an ETF, it's on the shelf. I'm expert enough to see that this is something that's not going to go away. I think focus on different aspects of the ES and G. I think obviously a lot of focus on climate change, a lot of focus in terms of looking at governance, corporate governance within institutions. These are all aspects which are now part and parcel of any kind of investment committee, and these are all sort of becoming the norm. And I can see a situation where in a few years' time, the majority of indices could be ESG, and the non-ESG will be the minority. And I think that's the way the market is going.
Yeah, so thanks. I mean, it will be interesting because if the sustainability element of it and good governance, you would think that a company that has a sustainable model and has good governance will tend to outperform over time anyway. And even through natural selection of ETFs, which, I heard a great phrase where someone described passive management as just slow active management. And if you think companies that do well because they've got a strong ESG agenda, they should naturally become larger proportions of indices, even without any kind of proactive effort. But as you say, that's likely to occur as well. So, Manooj, I've taken up quite a lot of your time so far. I'm wondering if you have any kind of closing thoughts about sort of the industry, or what your intentions are, or thoughts and ideas about where we go from here. It's been an interesting 20 years. What about the next 20 years?
I think there's a lot of for the ETF market and just asset management in general. I think the market has both opportunities and challenges. Opportunities are that we all need to save. We're all living longer. We all need to make provisions for the later years in life. And obviously, with a lot of countries like China, emerging markets, which are also heading in that direction, there'll be a lot of money to invest for investors, invest for sort of people's pensions, but also long-term savings. We are in a situation where I guess the challenge will come from the focus on value for money and ensuring that investors get a good deal. And with the emergence of ESG, I guess this is another kind of layer that's coming into the kind of the investor toolkit to consider: is that value for money plus is it doing the right thing? So the combination of the two, if you can tick most of the boxes in both camps, then there's a lot of opportunity. And I think with ETFs, it is possible to do that, and that they have a bright future ahead of them to continue growing and play an important part in the growth of the asset management industry, but also in terms of investing for investors, delivering them with good value, right type of products. I think financial services is one of those areas where, unfortunately, you will have to compete on price. So I can see that the products will also continue to be very attractive in terms of pricing for investors, which can only be a good thing for the end investor. Presents challenges for the providers, who then need to become more efficient, more sort of focused in terms of what they're doing. But overall, I see it as a positive outcome, both in terms of the challenges which lay ahead, but also the opportunities.
Right. Well, I think that's sort of a good recap of life, really. Challenges and opportunities, and expenses count.
Yeah.
Great. So listen, thanks very much for your time. Really appreciate your thoughts and sharing your time and views and history on this critical environment. The size of the market of ETFs in Europe today is huge and only growing. And it seems that people finally have recognized the value of ETFs and portfolio construction in terms of determining their own portfolios for the future. Say we're all hopefully living longer and healthier, and that costs money.
Yeah.
So thanks very much, listeners. I will be back in a couple of minutes to do a recap on this episode. Manooj, thank you so much for taking the time.
Very much, Roy.
So that's a wrap for this episode. Manooj really took us on a journey of the ETF market development from the late 1990s to today. And that's good because he was an integral part of the whole development. From the early days at Merrill Lynch, where he was part of that team that launched the Leaders product, it was launched in April 2000, which just pipped iShares to the post by 2 weeks as being the first listed ETF in Europe. At the time, ETFs were largely a retail product, and Merrill soon found itself as not really wanting to prioritize that at the moment and selling the business. Manooj soon found himself part of the team at Deutsche Bank, and they had a target market of institutional investors that were starting to use ETFs as part of their portfolio construction building blocks. So it was really transitioning from really retail focus to more institutional applications. But the great battleground at the time, which is really when I first got involved with ETFs, and for the few years after that, was really the debate between synthetic ETFs backed by swap contracts versus physically backed ETFs holding the underlying securities. Now, at the peak of the debate, Manooj told us that 45% of the European ETF market was synthetics. I didn't realize that it had reached such a peak. And those were largely delivered through the investment bank ETF products. Synthetics had the advantage of lower costs and more direct replication of index performance, but they really suffered from this kind of perception of being more risky than the physical ETFs. And that's even though they really led the way in terms of transparency of who the exposures were, what collateral was being held, and really setting the standard for that. But look, whether or not it was true, and I actually co-authored a white paper in 2012 that highlighted some of these issues, it didn't really matter. Physically backed ETFs won the war. I'll be including a copy of the white paper in the show notes for this episode. But nevertheless, I think it was really interesting. Manooj talked about the DWS ETF business, which, as I said, second largest in Europe, where the percentage of synthetics in their offering dropped from 100% to 20%, but the absolute number, in fact, showed higher assets under management by DWS synthetics at the end of Manooj's time at DWS this year, much higher than they were when it was 100% synthetic. So that really shows how the ETF market in Europe has really exploded. And it seems like there's a time and a place for everything, and it'll be interesting to see whether synthetics make a comeback in the market. It still is the only way to get access to some markets. and certainly a better way of tracking many of the indices in terms of just pure performance. So Manooj, in his role, of course, has been a client of securities lending programs, and he identified it as an essential way of adding value to the funds, irrespective of the structure of the program. And I think the words he used to describe securities lending was top of mind. And I like to think of the business as being that way. So it's good to hear someone say it. He also encouraged ETF holders to make the ETFs themselves available for loan. And again, the white paper addresses that issue. And I completely join Manooj in recommending that if investors are already lending, that they make certain that their ETFs are also available for loan. Now, everyone's talking about ESG, and I couldn't resist asking Manooj about his views. And he observed that the majority of launches these days seem to have ESG screening as part of their metrics. And in his view, ESG is here to stay. So there you have it, the development of European ETFs from a man who has been part of it from the very beginning. I hope you learned as much as I did. I'd like to thank listeners that have given us ratings, because we finally have ratings now. So thank you very much for that. I really appreciate it. It'd be great if more of you could leave ratings, and maybe a couple of people add reviews. That would be cool, because that helps us get more great guests. I'm interested in your feedback either way, though. Love it. Or if you think that the show could do with some tweaking, don't hesitate to let me know. In any case, we have some great guests lined up. The next show will be an interview about short selling and responsible investment. And we have a number of other guests primed and waiting to come on. As always, we encourage you to share topics or guests you'd like to hear from. So drop me a line at roy@peerpoint.info. And again, all of our contact details are in the show notes, as well as Manooj's details. If you haven't already subscribed, please do so and tell all your friends. We provide a lot of securities finance content, and we've got a couple of new courses that you can see on our website at www.peerpoint.info. We're active on LinkedIn and Facebook as Peerpoint Financial Consulting, and on Twitter as Peerpoint FC. The other thing I'd invite you to do is on Tuesday, the 24th of November at 3 p.m. UK time, we'll be doing an introduction webinar where my partners at Peerpoint and I will all be talking about the kinds of things that customers talk to us about and how we can help. I'm Roy Zimmerhansl. This has been Peerpoint Perspectives, the art of securities finance, and I look forward to catching you next time.